Good morning. Happy Saturday to everybody. As we're getting into the spring season, finally. Hope you're all doing well. I'm in the last throes of my last tax season. So I think it's my last one. Their tax season's really giving it to me good this year. But it's going okay. I didn't get to do as much in the presentation here because of that. Just as you can imagine, with less than 2 weeks to go, we're kind of pretty busy, and I will probably have people walking in here soon. So I apologize if there's any noise on that, but we're getting to the end here. And the final one, the final frontier. So, and I'm going to keep briefing you, as I've mentioned, looking to merge firms. So I'll keep you abreast. It's something that's not going to take place until we're hoping the beginning of 2025. But, these things take time, but I'll keep sort of briefing you as things become clearer on what's going to happen on that. So yeah, a lot of moving pieces in my life. So today, like I mentioned, it's going to be a little shorter than normal, but let's jump in and get rolling with it. So I will turn on the slides. So the first thing, it may not even apply to most of you, but if you have kids in college, this is a pretty important detail. As you may or may not know, the FAFSA has been reconfigured. So the FAFSA is what you file in order to get your aid packages from colleges. It's basically what is used to determine how much money you should be granted for your children to go to college. And they've been talking about this change for a long time. It was actually supposed to take place in 2022. But it because of some sort of outrage from, parents in the community and colleges, and, people couldn't get it rolling quick enough. The government delayed it for 2 more years. And of course, the government has now launched the FAFSA this year after a 3-month delay from what the day they usually October 1st, you can open up and do your FAFSA. They had to delay that for 3 months. But as you would expect, or at least I would expect, every other part of this government operation has been a complete disaster. No shocker there. So there's, just unbelievable number of technical glitches. Either when a family gets done with the FAFSA, there's actually an incomplete calculation. So they don't really know what their family's expected to contribute to their college education. And I found out that even 20% of the tax information that they're pulling in from the IRS that goes to the schools, 20% of people are getting wrong information sent. So, if you're a millionaire and they send somebody's return to the schools that's, say, maybe an earned income credit or something, low income folks, that would be great for you. But if you're kind of a normal family and they send a millionaire's tax return to the school and you don't get any aid because of it, that'd be kind of disastrous. So the big takeaway, telling clients is when you do this FAFSA, really, you have to look and see if it makes sense. And the thing you can do is appeal to the schools you're applying to, stating that the FAFSA does not really capture my financial situation. So any school that you apply to, your children apply to, you can appeal the FAFSA decision, and you might have to do that. So if you do the FAFSA and it looks out of whack, it's saying you could contribute $50,000 a year and you only make $60,000 a year, that's probably a problem there. So you can appeal to the schools. So really, really look at it closely, because it's just a total government mess, if that's what you're talking about. So take a look at that. Make sure it's looking correct or reasonable. And I know you probably don't know what's reasonable, but it might just be a good idea to appeal to schools anyway. I'm looking here. Rob made a good point. The FAFSA was required no matter what. Even if you're wealthy and you're going to be paying for it, they still want you to put that in because it does have an effect. And sometimes, to be fair, if you put in the FAFSA, there could be a scholarship that your child is open to getting. Could be based on GPAs, could be on something. So yeah, they definitely want that information. But yeah, it's a complete disaster so far. Just being a 3-month delay all of a sudden means that the schools have 3 months less to determine how much aid your child should get and who should get aid. Makes their life a living hell. But now with all these errors, they're going to get tons of appeals. It's going to be horrible. So, okay, enough on that. So one of the trends that I'm kind of watching right now, is inflation coming back? Are we starting to see sort of a return? Is the empire striking back at consumers here? And if you've been to the grocery store, you probably would wholeheartedly say yes to that. Agricultural commodities are definitely going up. But we have a kind of interesting situation in that a lot of times you look at the government figures are showing kind of a different picture, but the current market prices are trying to tell a different story than what the government data shows. And look, already been bashing government and try to bash the government data, but for the most part, I think the government data on things like inflation, while there's certainly, I could do a whole coffee with Kirk on how they kind of manipulate the inflation, but as long as it's consistently manipulated, we can kind of draw inferences from it. So a lot of the data, it is good data, and it's what the market sort of bases their prices on. And a lot of times this government data leads the market because market participants wait until they see this data to make decisions on what's going on. But what we're kind of seeing right now is the current prices on the ground. What the market is saying is very different than what we're looking at for the government. And as I mentioned, the biggest one that you're probably going to see is agricultural commodities are definitely heading up right now. If you look at this chart here, it just basically shows the year-over-year change of inflation, which is the white line, compared to agricultural commodities, which is in the red line. And you can kind of see with the white line, we have had moderating inflation. So things have been pulling back on that. But now recently, we're seeing that ag prices are really jumping. And part of it, the thing about commodities too, is commodities, it's not just supply and demand. It's not just supply and demand as like people buying things, but you also have issues with commodities that weather patterns could have a bigger impact than it does in other markets. And I think that's kind of playing out a little bit in South America. I haven't dug too deeply in that, but if you look at the price of coffee and cocoa, which are two big products that come from South America, those prices have absolutely parabolically skyrocketed. So if you like your chocolate or a coffee, you might want to load up a little bit now, add a little bit more to the grocery list and buy some. Go to Costco's and get a big old bag of it, buy in bulk, because I think prices are definitely going to go up there because the commodity prices have gone up. The other thing that they have, there could be a lot of geopolitical risk are on commodities. So you have that play that's typically not something you might see from a normal stock. But clearly agricultural commodities have started to climb. And the prices on other commodities have really jumped. One that's really gone up quite a bit is gold. You can kind of see, this is the ETF that we own, the Aberdeen Physical Gold. So again, to give you kind of an idea of what you're looking at here, the green line that you see, this single green line, is the 200-day moving average. And then the really squiggly up and down line, that's current price. And when it's blue, it's price going up. When it's red, price going down. And then the last thing is that overlay of the blue and orange. That's just another technical indicator I created to try to track shorter term movements in the 200-day. But you got to see the current price of gold has really gone up considerably here this past 2 weeks. And I put down at the bottom, this is what you call the relative strength indicator, RSI. So relative strength just is basically showing, when it's at the top of the range, it means there's just a lot of people buying. And then when it's at the bottom of the range, it means it's a lot of people selling. So when you get an RSI above 70, on a short-term metric, you probably could expect some sort of pullback. It just means that there's just too much strength for purchases. And then when you see the RSI down at a 30 or below, that's typically saying the market's a little too bearish and you could see a correction. And if you start to look at the RSI graph and then go straight up to the price of gold, so if you start at the middle of the chart, you see that RSI dropped down below 30, and I think it got down to 22. And you can see that's exactly when the price of gold had bottomed. And as the RSI, as the movement and buyers came in, as the market was too bearish and buyers came in, the price of gold did go up. So what it's telling us right now, if you go to the far right of this graph, you can kind of see the RSI is well above 70. So I always like to have gold in the portfolio, and I do kind of think there's a compelling case for it over the longer term here, because we talked about this last time, and I've talked about it several times. I do think we're in a longer term inflationary trend. So I think gold will be a good performer over longer term. But in the short term, you might want to hold off a bit. I've got a couple clients that we're looking to buy in. I might hold for just a bit, get a little bit of a pullback, and then probably go in, because it's a little bit ahead of this. It's in front of its skis right now and might be due for a pullback. Same for silver. Silver's finally kind of breaking a really long-term trend. This is just a year. But if you go back and look at the 5-year, I guess I should have put a graph on there. While silver's up quite a bit, it's still, well below kind of a longer-term trend, but now it's starting to move towards that. And if it does break the longer-term trend, we could really start to see silver start to move, because the price of silver relative to gold is at kind of a low end. So if we get any kind of mean reversion where we get to a normal level of ounce of silver to an ounce of gold, you could probably see a pretty good move in silver. But all that said, again, if you look at that RSI, it's awfully high right now. So we could probably see a little bit of a pullback here in the near future, next week or two, on silver. But again, it's kind of definitely in a bullish trend without a doubt. Now, silver and gold aren't necessarily any commodities that affect the price of inflation, the prices that you'd really start to feel. But they are kind of a telltale on, is inflation coming or not? If we weren't expecting to see inflation, or the market, I should say, then you would have really no market for both gold and silver. They'd be flat at best, or probably losing value. So you typically don't see those two move like they're moving in an environment where you don't see inflation. This is also just a chart. As you know, I'm kind of a big uranium bull, but it has been really a huge move up for uranium. But it doesn't look all too bad on its relative strength right now. It's certainly gone up quite a bit, but I still, while we could see a pullback in uranium only because it's gone up so much, again, I think the long term for nuclear is it's going to start to play out here. I mean, if they really want to move away from fossil fuels, they're never going to be able to do it with wind and solar. It's just not going to happen. Even just the amount of fossil fuels it takes to operate and build and then destroy solar panels and wind farms and all that. It's not going to happen. This is the oil companies right now. So XLE is a basket of oil companies. You can kind of see that it's also had a really crazy move up here the past 2 weeks. Again, would probably expect sort of a pullback, but I'm big on energy companies longer term as far as the value, and relative to other sectors of the market, it's still pretty much a screaming value, but we could see a little bit of a pullback here. But what you need to look at as far as for inflation, what does this chart tell you? It tells you, look, I mean, if you're looking at energy companies doing this, either the market's just kind of gone batty, and there's some truth to that, or people start to see that inflation's coming back. Now, commodities in general, this is a commodity holding that we've got a little bit in, and I'm probably going to add more to it. This is the Aberdeen all commodity strategy. So this is going to invest in 24 most liquid commodities. So it has not only the precious metals of gold and silver that we talked about, but it's got oil, it has natural gas, it has agricultural and industrial commodities. It's got livestock. So you're talking pigs and pork bellies and beef and that all those kind of things. So it really looks at all the commodity infrastructure. And while the past three charts I showed you kind of look like just a crazy commodity investing environment, really commodities haven't done very well here the past year. They're down quite a bit, but you're starting to see them perk up, and they've just broken through the 200-day moving average. So commodities in general are starting to really come back. And when you see movements like that, you got to think that at least maybe the market participants are expecting more inflation. It could fade. It could absolutely fade. But, it's a telltale. So then I looked and said, well, what's the dollar doing? So if the dollar is depreciating relative to other currencies, then the price going up in commodities could be explained away just from the dollar. So it's not necessarily a bigger trend in commodities. It's mostly just, hey, the dollar's getting weaker. But if you look at this, not really seeing that. You're not seeing a complete breakdown in the dollar. Again, this is a year chart. So kind of the far right bottom there, that was, I think, October of last year. So you can kind of see since October, the dollar's actually strengthened, or at the very least gone sideways. And it's gone sideways here for the past few months. So it's not that it's any kind of currency play driving this. It might be just a fear that inflation's starting to come back. So people are starting to put money back into commodities. Now, jumping back to my point about how the government statistics just aren't showing that case. So maybe this is just market opportunities, people saying, well, commodities are cheap. Let's get some short-term gains. You jump into commodities, they appreciate, and then people are going to bail, get out of it, and we're going to see the price of commodities just come right back. That could happen. That could be what's going on, because we do have kind of a divergence between, what the story, the official story that from government statistics is saying and what the current market prices are saying. So this chart is what they call the PPI. This is the prices that are paid by corporations to make their products and services. And you can see, it's been coming back just like the regular rate of inflation. So the PPI is really kind of a leader of the CPI, which is what we mostly feel, because if the PPI, if companies are seeing prices go up, they feel it first, and then of course they pass it along to us, and then you see the CPI go up. But that's not really happening. We're still seeing kind of a decline here in PPI. Now, another weird thing saying that maybe things are different. Maybe the current activity in the markets is very different than what the government statistics are showing. This looks at TLT, which is the 20-year Treasury ETF. So if inflation is moderating, if it is going down, and again, what this is showing you is an overlap between the PPI. This is the same graph I just showed you. So it's this graph, but it's overlaid with the TLT, but TLT is inverted. So basically, the graph for the TLT here is going up, it actually means TLT is going down. And to confuse you a little bit more, remember when bond prices are going down, yields are going up. So what you could look at this and say, the graph you're looking at here, the orange line or gold line, as it's going up, it means that bond yields are going up. That's probably the easier way to look at it. So if inflation is moderating, then you'd also expect that bonds their yields would moderate and come down. Because when a bond is priced in, the biggest threat to you as a bond investor is inflation. I mean, certainly there's risk that you could have a default, but the biggest risk is that if you buy a bond at 3%, but then inflation's 8%, you're losing 5%. So bonds are always pricing in inflation because they want to make sure that when they purchase the bond, they're going to at least make sure they're keeping pace with the price of inflation. But what we see right now, again, the PPI numbers are coming down, saying inflation is being moderated, but we're looking at bond yields once again start to rise. So bonds are saying, look, this isn't, we're not seeing the same thing here. Now, it could be the market's just trying to say, all right, well, bonds got cheap, let's buy them. Or bonds got expensive, let's sell them, we'll buy them back later. That could be, just like the commodities. Commodities got cheap, we bought them, we'll sell them, and then we'll buy them back again later when they get cheaper again. That could be happening. But what I'm looking at here is we have now two asset classes that are basically not acting like inflation starting to moderate. We've got commodities, clearly, and now we also have bonds that are acting this way. So is it the fact that inflation's starting to come back up? And just to kind of give you an idea of how PPI and CPI eventually come together, you sort of see there's a very strong correlation between both of them. Like I mentioned, PPI usually is a leading indicator to CPI, but they both basically track exactly alike over the longer term. But you can look at this, if you look at this closely, you'll see PPI makes a move and then CPI closely follows it. The other reason we should be seeing more of a deflationary environment, or at least a lower inflationary environment, and I've talked about this, is just, the money supply has been being drained, not drained, but being pulled back. As you look at this, if you see I got the black line for inflation, which was the big jump we saw back in 22, in the 23. But you can also look at the M2, which is the blue line, that's total money supply. It also, about the same time, or actually a little bit before the inflation spike, that's when we saw the monetary spike. So the fact that now we're starting to see a little bit less of a money supply, certainly way higher than the trend line, but we're starting to see that pull back, and we've started to see inflation pull back because of it. And that's kind of a natural response. So looking at the fact that money supply is going down, inflation should be going down, bond yields should be coming down, and commodity prices shouldn't be going up. So is there something afoot here? And it's something we'll have to just kind of watch. You don't really know until later. But to kind of give you an idea, just in the most recent inflation data, there's really kind of two. There's a general CPI and then the core CPI. So when you look at the core CPI, it did have a big spike this last month, and you can kind of see I've got the little red dot showing that. But then if you look at the 10-year break-even inflation rate, so this is what the market is kind of expecting, that bonds should yield above inflation. The blue line's at about 2%. So right now it's saying if you buy a bond, you should probably make sure the rate of inflation cost is going to be 2%. So part of the markets are saying, we don't expect long-term inflation. but yet the very short-term data is showing inflation spiking up. So the thing to watch is this something that it's just a short-term anomaly, or are we actually seeing a reverse of inflation? Another thing, we've shown the price of gold going up considerably, but it's gone up in a way that it's broken its natural correlation to the 10-year Treasury inflated protected securities. So these are treasuries that inflate with CPI. So as you look at it, the TIPS yield is really tied to this 10-year break-even inflation rate of 2%. So TIPS have it's one part of the bond market that has kind of tracked what the official CPI data is showing. So TIPS are still expecting less inflation, but yet the price of gold is saying the opposite. And if you look at this chart up until really 2022, 23, it's been a pretty strongly correlated chart. Gold and the TIPS yield tend to move, and that makes a lot of sense. If you're expecting inflation to go up and the TIP yield goes up, the price of gold's typically going to go up, and vice versa. But we're starting to see that thing break down. So again, it's something to watch. We'll see. But the one thing I've talked about this is, everything is cyclical in nature. You have longer term trends and shorter term trends. You have what they call secular markets, secular bear markets, secular bull markets. These are 10 to 20 year periods where you have a general uptrend or a downtrend. And commodities are an asset class that really, really are affected by that. I showed a chart, the last Coffee with Kurt, just showing the diversification of having commodities. And when you added commodities in some periods, it really helped your portfolio because commodities were doing well. And then there was 10, 20 year periods where it hurts your portfolio if you added it in there from a performance standpoint because they didn't do well. But the one thing it did do is it lowered the risk of your portfolio overall having commodities. But what I've been saying is I think we're in a longer term inflationary trend here for the next few years. And this chart kind of gives you an idea that commodities, when you divide it by the price of the stock market, is at lows that we rarely see. We've only kind of seen it 2 times this low. And both times when we reached this low, it corrected in a sizable manner. So that usually commodities had a longer term period of outperformance, maybe a 10, maybe 15-year period of outperformance. Now, it could be a couple things. Either the markets stay where they're at, commodities just go up in price, or it could be commodities stay where they're at and the stock market comes down, or a combo of market comes down, commodities go up. But if we are going to experience an inflationary period, you'd expect that the price of commodities is probably going to continue to go up, which would be a drag on stock prices, or at least limit stock prices quite a bit, especially when you have, stock prices at extremely high valuations. So, when you look at that, you could argue that it might not be a bad time to have some commodities in your portfolio. I just threw this out there. I saw this graph. The thing about investing in gold, but even commodities in general, it's not necessarily so that your performance is going to be phenomenal, but with gold in particular, what it is, it's a great store of value. So you know that you're going to keep pace with costs that are happening around you. And this just shows you, like, 1 kilogram of gold back in 1920 would have bought you a Model T. And today, 1 kilogram of gold will buy you a Ford Explorer. So you can keep Henry Ford's company in business using gold, but you can sort of just see that that's what the value is when you're, purchasing gold. And to kind of keep on the investment strategy or the potential for commodities, there's also great potential for gold and silver miners. Just like commodities are at kind of a low relative to the market. Right now, miners are at lows relative to the price of gold. So if you're looking at it, it's probably a good time to look at it. I haven't gone back into any miners yet. They're still kind of struggling, but you got to think that if this move up in the price of gold and silver is legit and it's not just a short-term trading move by the market participants, then at some point the miners are going to do well because they're pulling these metals out. And if the price of the underlying product's going up and costs can be somewhat contained as far as paying for equipment and personnel and of course political issues that could arise, but you're sort of seeing that it's probably a pretty good time to think about that because there's some potential there. This is just another chart sort of showing you the price of gold relative to gold miners, just another way to look at it. But the other thing too is you start to look at the miners, what they were feeling for a while is when the price of silver in this graph or price of gold and silver, when they weren't climbing, but yet we had inflation, that meant that the cost of production was going up. Again, paying more for staff, paying more for equipment, probably paying more in leases, things like that. So it became less profitable to be a mining company. So you pull back on your mining. And so we're starting to see that the actual mining production has been going down and it's quite low relative to the past 15 years or so. It's still above where it was, say, in the early 2000s. But back in the early 2000s, price of silver was probably $4 or $5 an ounce. So there really wasn't much motivation to be able to do any mining back then. So for right now, you could look at it and just say, look, it's with the price of silver going up and mining's been low, you got to think that these miners, the amount that they're extracting, they're going to make more profit on the extractions. Another thing to look at is, we looked at the XLE in the early part of this presentation, which is oil companies, and it looked like, man, they just jacked up. They just started to really move, but they still haven't really moved in concert with what the price of a barrel of oil has done. This chart just kind of shows you, it's a little bit, it's hard to read a little bit, but the black line is the price of crude oil and the blue line is the price of energy stocks. So basically it's looking at the entire energy stock universe. And you sort of see, if you look at the black line where it is in the far right, this was at 87 a barrel. It's just recently hit $90 a barrel. There's still quite a divergence that usually doesn't last that long. You can see it's a pretty strongly correlated graph. So to have this kind of divergence, I think there's still probably some good room in oil stocks. As I mentioned, we could see a pullback just because the move has been pretty robust here in the past 2 weeks and the RSI is awfully high, but still the longer term trend here looks like there's some room for oil stocks to do pretty well. Okay, so that's talking about that. And then I finished with a sort of a contrarian look at things. And I'll start off saying why I got this. I look at a lot of different sites and follow a lot of different people. And one guy I follow had this presentation, and he was trying to talk about contrarian indicators, or I guess leading indicators, or what it is looking at discretionary spending. So if you start to look at areas that have a lot of discretionary spending, that can kind of tell you what's really going on with the economy because it's a leading indicator. So the first one pointed out was RV sales. So this is RV sales through 2023, 1980 to 2023. Now you can see the past few years, RV sales have been very, very good. coming out of the '08 recession, you've seen pretty much a climb up, except for obviously the COVID year. But even once COVID ended, holy cow! I mean, look at that. RV sales hit an all-time high. But 2023, it's kind of pulled back considerably. I mean, that's a sizable drop there. So RV sales is certainly something that people only buy if they have discretionary income. If you're having trouble feeding your family, you're probably not out looking for an RV. Another good one, and I couldn't find a good graph on this. I do apologize. So what this is boat sales, and it's only looking. This is from you're comparing 23 to 24. It's mostly just how's the year starting. It's not. I couldn't find one that showed like a 10-year graph or anything along those lines. There are sites that do it, but they charge for those graphs. I'm like, I don't know if I need to make my point to pay for a graph. I'm a cheapskate after all. Come on. So my discretionary income is not to the point where I'm buying superfluous graphs. But anyway, you can sort of see, I mean, even starting the year off, it could be a weather event. I mean, maybe January of 24 was a worse weather environment than 23. I don't know, but we're already starting to see a pretty sizable downturn in boat sales. I think the only one that went up was houseboats. There's only 4 houseboats sold in January of 24, whereas there was 2 in 23, but maybe people are looking to live in a houseboat. But the point of this guy's little YouTube video was mostly he was talking about looking at kind of the sex industry. His point was when, people have that discretionary income, it's probably not going to go to the strip clubs. And there's actually something that they started to put out there called the stripper index, and trying to watch and see how much money are strippers making. They're trying to say, look, yeah, RVs and boats are certainly a discretionary income. But, if you always wanted a boat or an RV, you might try to find a way to make it work. If you're retired and you have more time, all right, maybe you don't have quite the discretionary income, but you always wanted it. So you might still do that. But going down to a strip club, maybe you won't do that. That's probably pretty clearly a discretionary thing. And he put out a video. There's actually a video from a woman who works at like one of the bunny ranches in Nevada, and she showed her 1099, and it was down 50% from the year before. And then he showed another little video from her, which I tried to get on here to show you. It was pretty interesting. She was doing a video saying how Jeff Bezos has sold 1.8 billion of Amazon stock, and how Morgan Stanley's CEO sold stock for the first time ever. So, and then there's the Walton family sold $1.5 billion of Walmart stock. And so a lot of CEO type folks are selling sizable portions of their stock. And she was pointing this out. And then her final point was, some of the guys that come see me they're on the inside a little bit. So you might want to think about it. But I couldn't figure out how to get a TikTok video into the software I use for this presentation. So I couldn't spend time on that. And I'm like, that's enough. I'll just tell you. If you really have an interest to see the video, let me know. I'll email you a link. You got to be careful. I was very cautious when I was doing it. It's hard to go on a prostitute's TikTok site, and if you get caught by your wife and you're trying to say, no, it's really, I'm doing research for my business. Probably not going to be able to make that argument. It's probably like when your mom caught you with a Playboy and you're trying to say, oh, no, the article's really good, Mom. I'm not going to buy it. So I was very careful when I did that. But if you are interested, I'll send it to you. Just don't blame me if your spouse catches you and puts a certain punishment on you, I guess. Anyway, I'll finish up as we always do. Lawyers say hello. If you need to read this, please pause the video. All right, so we'll stop on that one. Okay. Let's see what questions we have here. Yeah, interesting comments. Yeah, so you never really can fully trust the government statistics, but what you can look at is they're going to consistently manipulate things. So you still look for longer term trends in that and try to pull out what's going on today. Does it match what's happening? But a lot of good points. The administration's numbers are being revised down the road, and that, again, I'm trying to be fair. These statistics are always revised. They are difficult in many cases to get it right the first time. So they acknowledge that there'll be revisions. It does seem like the revisions now are much bigger because it doesn't get the same news story as the current figure. So on both inflation, jobs, things like that, if you really want to get good data, you've got to dig a little bit deeper and look at the revisions. It really tells the story. Good point from Scott that the input costs for agricultural products, fertilizer, fuel, regulations are hitting hard as well. And that's absolutely true. So really good points that so the inputs are going up, but government regulations are a huge part. And that's one of the reasons I think we're in a long-term inflationary trend, because especially on energy, the amount of government regulations coming in is going to slow production. And it's also clearly slowing exploration and refinery capabilities too. So all of that's going to start to play out over the longer term. Okay, so it looks like that's pretty much no real questions on that. But I think the big takeaway is we've got to watch and see, is this inflation reigniting itself? Are they getting too loose, saying they're going to cut rates? I think the stock market jumped when they thought, well, the Fed is going to cut rates here. So the market went up considerably. What if that doesn't happen? Or if commodity prices go up and bond yields go up, both of which have a huge impact on stock market prices. What happens there? So I'm probably going to talk about that next time and just start to look at those issues a little bit, because I think that's really what we need to see. The other thing I'm going to talk about in the next presentation is just why the Fed might have to lower rates no matter what, because we're getting to the point now that the current interest rates are really starting to affect the government. And the government's getting into the season where they're going to be going back onto issuing more debt. Typically, the first 3 months of the year, they don't need to borrow as much. The spending's not as high. They also have a lot more tax revenues coming in because a lot of the final quarterly estimates come in. And people are settling their tax bills. So they don't have as much of a need, but the amount of debt that's coming in starting in this month, April, and going forward is going to be sizable. And I did a presentation a few months back talking about how we could see $1 trillion just in debt repayment this year from the federal government, which would make it a larger expense than the military and only behind Social Security and Medicare. They're saying right now, if rates don't come down, it could actually end up being 1.6 trillion. So now we're talking, it's going to be darn near as big as Social Security and Medicare. So we're in a situation where the reason the Fed might be switching from, last year was all, hey, we're not lowering rates. And then in in October, they said, oh yeah, we see rate cuts coming. Stock market took off, and especially stocks that are high beta, which move faster than, they're more volatile in the market. Tech stocks, the Magnificent Seven. So it's going to have an impact. So the Fed might be forced to cut. And if that happens, then we're definitely going to see, if we have inflation perking up and then the Fed does cut, we're going to be back to seeing really sizable inflation. So anyway, thanks for checking in. It didn't turn out to be all that short after all. If you have questions, please send the questions to me. I'd like to talk about those things. So I hope you have a great weekend, and we'll see you next time. Take care, everybody.